Hey everyone, and welcome back. Today, of course, we're going to be doing part 2 of the video that I released a few days ago. So if you haven't seen that video, jump over and watch that. I'll put a card to it up there, I think, and then I'll leave a link to it down in the description below as well. So if you're seeing this and you haven't seen my video that I posted on COSTCO a few days ago, go watch that one first and then come back here. But today's video is, of course, the second part of this full stock analysis that is some of, or a taste of, the exclusive content that you can get access to if you want to join Learn by Example, which is now currently open for October enrollment. Learn by Example is a platform and private investor community that is best aimed at people who have already got a basic understanding of Warren Buffett's value investing principles, but are ready to take their analysis to the next level. Students get access to over 120 hours of exclusive content, including over 70 hours of example stock analysis reports and presentations. Today's video, you're going to be seeing the full 1 hour COSTCO analysis that I did earlier this year. And also for those who have seen the first COSTCO presentation, this is a new one that I did, an updated analysis I did this year. So if you've seen the first one, you'll still want to stick around and watch today's video. On top of the huge catalog of past reports and presentations, a new stock analysis report and presentation on a new company is done every 2 weeks. And these written reports and video presentations can serve as examples of deep analysis on real companies so that you can learn how to apply that same process, that same analysis principles to other businesses that you're looking to invest in. You also get to join our private community of 300 investors, and I'm active in that group almost every day, and I answer every single question that gets asked in that community. So if you have questions and problems along the way through your analysis, you can know that I am there to support you on a one-on-one basis, but also in a group setting. Also, once per week, we do a 60-minute Q&A live stream where you can again ask questions and get answers from me. And you can access a searchable library of over 50 hours of past Q&A sessions, which are filled with the huge number of questions that I've answered from students over the past 2.5 years. And if you thought all of that was a lot, you also get access to my crash course on valuation, which is a step-by-step course with exercises and tests along the way on how to calculate what price to pay for a stock. As I mentioned, the main feature of the platform is getting access to real deep stock analysis that I've done on real companies. And these are no kind of 10-minute YouTube summary analysis videos that you probably see from watching a ton of channels. These are deep dives going through each important characteristic and principle that is necessary in order to form a full opinion about whether a business is going to be a good long-term investment. And I'm sure you're going to see that in today's video, where you get to see the entire COSTCO analysis that I've done. So I encourage you to watch this video if you are serious about stock analysis. And I know this isn't going to be for everyone. Not everyone wants to sit down and watch a 1 hour analysis. But if that is you, then I highly encourage you to sit down and watch it. And if you want to access more examples like that and then come work alongside me, Learn by Example is now open for enrollment for October. There's actually 50 spots available at the moment. They typically go pretty quickly. So if you're interested, you might want to get onto that fairly quickly. And also, as always, during these promotional periods, you can get a discount. This time it is 30% off. So if you use the code October at checkout, you can get 30% off when you sign up. But of course, that is only available during October and while those 50 spots are available. My contact details are down in the description below if you have any questions before you sign up. But with that said, let's jump into the COSTCO analysis. So moving on into management, and I know this has been a long presentation already, and we're only into the third section. So again, I'm going to sort of go relatively quickly through some sections that I think we've kind of already covered in the previous presentation. So I recommend you go checking that one out if you haven't before watching this one. I probably should have said that at the start of the presentation. But in management section, of course, what we're trying to do is assess the people making decisions on our behalf. So we'll start off by going through management's integrity and having a look at the people running the business and whether we trust them based on how compensation is structured. So COSTCO was founded in 1983 by James Seingel and Jeffrey Brotman, who both served on the board of directors until recently. Brotman unfortunately passed away in 2017, and in 2018, Seingel stepped down from the company. So the founders are no longer running the company, but they have been until very recently. So let's talk about some principal shareholders, which is a section you will find in the proxy statement if you want to look at who are the biggest shareholders of the company. The current CEO, Craig Jelinek,
Craig Jelinek, who has been a director of COSTCO since 1984 and has been CEO since 2012. So even though this CEO has, he's new to the position relatively, and he's not the founder, he has worked at the company. He's been a director at the company. So he's been at a high level in the company since the first year was founded. So he's not the founder, but he's the second best thing to the founder, someone who's been at the company over the entire period. He currently holds 333,000 shares worth approximately $135 million, representing less than 1% ownership, which is of course fine. He owns a lot of stock, $135 million. The second largest individual shareholder is someone you might know, Charlie Munger, who holds 186,000 shares worth approximately $75.7 million. And Munger has been a director since 1997. Now, that $75 million is Charlie Munger's personal investment, right? He also invests indirectly through the Daily Journal as well. So, Charlie has a little bit more of a stake if you add together his indirect holdings, but directly he holds $75 million. So then we can have a look at the summary compensation table to see how is compensation being paid to these executives. So in 2020, the CEO earned total compensation of $8.3 million in the form of salary, which was $1 million, bonuses, which was $200,000, and stock awards, which represented the bulk, which was $6.8 million. So from the summary compensation table, we now know that stock awards represent the vast majority of the CEO's compensation. So we can then jump over to the compensation discussion and analysis section of the proxy filing to see how is it being paid out. So stock awards form the vast majority of executive compensation and are vested, so paid out to these executives, evenly over a 5-year period from the grant date. So that's the first thing that's a really good sign, right? They're not paying these out in the first year. They're paying them out spread out over a 5-year period. Now, if an executive has been at the company for 25, 30, or 35 years, then vesting is accelerated to 33%, 66%, and then 100% in the first year. So in other words, executives are rewarded for staying long-term by speeding up the receiving of their earned compensation. So for anyone who's been at the company for 35 years or longer, when they earn their compensation, they get it immediately, which is fine, right? They've been at the company for 35 years. They've proven that they are dedicated to the business. The criteria for stock awards in 2020 was a 4% increase in total sales or a 3% increase in pre-tax income. Now, this is the area where I'm kind of the least satisfied with the way that they structured their compensation. I understand that it's difficult for their kind of business to have the criteria be an increase in sales, because of course they may end up, if they have a massive cost decrease, then they'll have a decrease in sales, and that's fine for their business, as we've spoken about. But 4% is a very low hurdle to get over. I feel like they're setting the bar a little bit low there, and I would also like to see that this was their stock awards was tied to management efficiency, their ability to invest capital within the business. So a little bit disappointing that it's tied to a really low bar that seems like they will easily get over every single year. I don't think they'll ever have a problem in the next 10 years beating a 4% increase in sales or a 3% increase in pre-tax income, but it is what it is. And overall, I am happy with how the management team is structured, with it being run by someone who's been at the business for, almost 30 years, or I think over 30 years, over 30 years. I'm quite happy with that. It's impossible to have compensation be perfectly what you want it to be, but that gives you an idea of some areas that I would have preferred to have seen in their compensation package. But moving on into capital investment, where we assess their ability to invest capital within the business, which is probably one of the most important parts of management, and is exactly why I like to see it in the compensation package. But Return on invested capital for COSTCO has been strong and consistently improving over time. The 10-year average ROIC has been 20.4%, and that has improved dramatically to 28.4% in 2020. So as you can see, very consistent over time and has improved in the last few years. So very, very good efficiency and improvement in efficiency over time. Since 2011, COSTCO has increased its invested capital by $12.4 billion, with $6.3 billion in long-term debt and $6.1 billion from reinvesting cash flows or an increase in equity. During that time, COSTCO produced $37.4 billion, indicating that the majority of their cash flow is being distributed to shareholders in the form of dividends and or share repurchases. So even though their business is very efficient, they're distributing most of their capital to shareholders, meaning they're unable to find good investments within the business to continue compounding at that 20% ROIC. So when they can't find investments that keep their efficiency at that level, they distribute it to shareholders. So since 2011, COSTCO has paid a total of $15.7 billion in dividends and done $3.8 billion worth of share repurchases. So of that 37-ish billion in cash flow that they produced, they distributed out about 20 and then reinvested a smaller portion than that. COSTCO has preferred dividends to share repurchases as the stock's price has been expensive on a consistent basis. So this is kind of just my opinion. I don't know if this is actually true, but I believe that COSTCO has held back from doing a lot of share repurchases because the stock's been very expensive over time. So that makes perfect sense as to why you would want to pay dividends instead of doing share repurchases when the stock is expensive. And then finally, for management, we have debt management, which is, of course, where we want to look at their debt on a short-term and a long-term basis and make sure that the business is primarily funded by equity and that they have a low level of debt, which reduces the risk to us as shareholders holding the investment over the long term. So as of the 9th of May 2021, COSTCO had current assets of $27.9 billion and current liabilities of also $27.9 billion, giving them a current ratio of 1. Now, 1 is, of course, below our minimum benchmark of 2.0. So 2.0 is what we're looking for. But it is above 1, which does indicate that they do have enough short-term assets to cover short-term obligations. So we would like to see this a little bit higher, but 1 is kind of the bare minimum. And I've said this in previous presentations, aiming for 2 or above, that's the best. But if it's 1 or above, we're okay with it. We're not thrilled, but we certainly need to watch that it doesn't go substantially under 1. It's acceptable. COSTCO has total liabilities of $40 billion and equity of $17 billion, giving them a debt-to-equity ratio of 2.4. Now, a debt-to-equity ratio of 2.4 is not acceptable. This is well above our maximum benchmark of 0.5, so we want this to be below 0.5. And it tells us that the business is primarily funded by debt and other kinds of obligations, other kinds of liabilities. Now, there is a little bit of pushback we can do here. So COSTCO was one of the businesses affected by the 2019 lease liability accounting change. So what happened in 2019 was an accounting change happened whereby leases, even operating leases for things like properties or warehouses, in COSTCO's case, they are now liabilities on the balance sheet, which increases the amount of liabilities, even though those liabilities for leases often reflect the amount of money that COSTCO needs to pay over, say, the next 20 years, because commercial leases are often 10, 15, 20 years. So if they have a 10-year or a 15-year lease, for example, on a warehouse that they have to pay rent every single month, all of that rent that they need to pay over the next 10 or 15 years is now a massive liability on the balance sheet. And in my opinion, that is something we can exclude because it reflects a slow, consistent liability that is going to be paid over 10 or 15 years rather than a debt that is due in the next 5 years, for example. If we exclude lease liabilities and the associated right of use lease asset, it's really important. You need to, when you're adjusting for the lease liability accounting change, you need to not only remove the lease liability, but on the asset side, you need to remove the right of use lease asset. If we remove those two things, then equity doesn't really change, but debt will go down a little bit, or liabilities will go down a little bit. And that means the debt to equity ratio calculation is now 2.2, which is slightly better, but is, a long way from being the 0.5 that we desire. A common theme in the shareholder letters and management discussion section in the annual report is management's intention to fund all capital expenditure activities with existing cash and cash flow from operations. With that said, COSTCO does operate with a higher than desirable level of debt, which increases uncertainty of future cash flows for shareholders. So what that little excerpt that I said, that I copied there basically means is it seems like management intends to not increase that level of debt, much further from here. So that can give us some kind of reassurance. However, it is still a higher level than desirable. So I would want to watch that over time. I would be extremely happy if they paid down their long-term debt because they really don't need to operate with it. And it would reduce a significant risk to shareholders if they dropped it. So with that said, here's the bottom line. Any of these sections, as I've mentioned, they're never going to be perfect, all right? So don't try and hold out for a business that hits every single little checkbox that we're going through in this process. You're looking for businesses that satisfy the vast majority of the checkboxes in each of the categories. So in COSTCO's management case, I really like the management team. Even though the compensation package is, it's not ideally set up, it's very, very good. It definitely leans on the good side compared to some other compensation packages I've seen. Their efficiency at investing capital within the business is extremely good. Their short-term debt is fine. It's just their long-term debt that is a little bit higher. So overall, I've still given them a pass on the management section. So with that said, we can finally move into the intrinsic value section, and there is a lot to go through here. So strap yourself in because we're going to be diving quite deep into fairly deep, as I've done in some of the previous more recent presentations about estimating future cash flow. And that's exactly what we're doing in this section. We're estimating what the future cash flows of the business might be, a reasonable estimation, not some moonshot that they could achieve world domination, but a reasonable range that we think is a very likely outcome, right? What's the most likely outcome? In doing that, we're going to start with cash flow growth. So future cash flow growth is always difficult to estimate, but it's made easier in companies with a strong management team and a distinct competitive advantage. Cash flow for owners is calculated by taking operating cash flow and subtracting maintenance capital expenditure. So management in their annual report describes their CapEx, and we can use that to estimate maintenance CapEx. So management describes CapEx as being used for, and quote, acquiring land, buildings, and equipment for new and remodeled warehouses. Now, that description seems to indicate to me that a significant portion of CapEx is being used to drive growth, right? It indicates that at least some level of CapEx is being used to buy new land, to buy new buildings, to buy new equipment, and to remodel warehouses, right? So some of it is being used for growth. And whenever that's the case, I usually end up leaning on the 50-50 side. So I'm going to estimate that 50% of CapEx is being used for maintenance and 50% is being used for growth. So therefore, we can run some calculations. So total CapEx was $2.8 billion in 2020. If we take half of that, we get $1.4 billion worth of maintenance CapEx, and therefore cash flow for owners in 2020 was the $8.9 billion in operating cash flow minus $1.4 billion in maintenance CapEx to give us $7.5 billion in cash flow for owners in 2020. As mentioned previously, since COSTCO essentially since COSTCO essentially acts as a buying agent for its customers, membership fee revenue has historically been very similar to net income, right? So COSTCO really basically just covers their costs for the rest of the revenue that they produce, which means the net income, their profit on the income statement, is usually very, very close to the membership fee revenue. So therefore, I'm simply going to project the growth in membership fee revenue and apply those growth rates to our cash flow models. So in other words, I'm assuming that the growth in cash flows so the money left over after normal operations and after maintaining the business, I'm going to assume that the growth in that is going to be very, very similarly aligned with the growth in membership fee revenue. And the reason why is because Costco's long-term business philosophy has been to be a buying agent, to only make profit on those fees. So the growth in those fees should be fairly closely aligned with the growth in cash flow for owners. Now, membership fee growth will be based on changes in two figures. One is the membership numbers, so how many memberships they actually have. And the other is the average membership fee, right? If you multiply those two together, you will get the revenue that they produce from membership fees. So starting with membership numbers, Costco currently has 58.1 million paying members, with the majority being in North America. Significant growth in the future will likely be driven by their expansion into China, which began in 2019. So basically what I'm saying here is they've penetrated the United States or North America to a significant extent. I still think they have a lot of room to grow there, and other, successful investors like Nick Sleep agree with me on that. However, I think the vast majority of growth is probably going to come from places like China. Approximately 15% of the US population have a Costco membership. So if the same density was achieved in China, that would result in an additional 209.7 million paying members. So that reflects right there the massive opportunity of investing and growing and expanding into China, right? If the same density as the US is now, the same density of memberships in the US now is achieved in China, then they could see a 5 times increase in their memberships. And that assumes that they don't increase memberships in other countries that they haven't entered into, countries that they have entered but they haven't fully penetrated, and even the United States, which I still think there's probably significant room for them to grow the number of stores that they have there, and therefore their memberships. So in that scenario, Costco's membership fee revenue would achieve a compounded growth rate of 16.5% per year over the next 10 years. So assuming they were able to achieve 200 million members in China over a 10-year period, they would grow at 16.5%. And that, of course, assumes that the price of memberships remains stable. Now, as I've said here, I think this is achievable, but an ambitious target. So I will use that growth projection as my 5th model, and I'll use more conservative growth projections in my other models. Okay, so I'm basically saying I think that they can achieve similar density of memberships in China as they have in the United States in 10 years' time. However, I'm going to say that that's kind of the upper end of my reasonable expectations, and that I'm thinking that a far more likely outcome, a far more common outcome in 10 years is that they underperform that expectation significantly, but that they still achieve some level of, massive increases in memberships across China and in other countries. Memberships in China are currently cheaper than in the US, so they're $42 compared to the $60 if you are in the US. However, membership fees are likely to increase over time, so I'm going to assume that prices stay stable. So what did I say here? So I think assuming stable prices is reasonable. Couldn't get that sentence out. So basically what I'm saying here is, as they expand into China, because the memberships are cheaper in China, they're $42, that's going to bring down the average price per membership for the entire business. However, at the same time, they're probably going to see some membership fee increases over that time. So as a result, I'm just going to assume stable prices, right? So I'm just going to start with that 16.5% per year compounded growth, which would come from them expanding massively into China, and I'm going to work around that percentage, and that's how I've achieved the growth rates I expect for the business in the discounted cash flow section. So, looking at this section now, as you can see, I have excluded the intrinsic value calculation from these models because it does not provide us with any useful information when interest rates are extremely low. The current 10-year US Treasury yield is 1.3%, and if we use that in our discounted cash flow model, we will end up with an intrinsic value calculation that makes no sense, and you can see the Texas Roadhouse 2.0 intrinsic value section for an explanation on that. The buy price is calculated using a discount rate of 22%, which is 8 times an initial investment over 10 years. And targeting 22%, of course, allows us to aim for 15%, but also have a 50% margin of safety for errors in our valuation. So as you can see, in terms of growth models, I've picked my highest model as that 16% compounded growth rate. And then I've worked all the way down to 8%, which is, half as much compounding per year over that period. And that's how I've come up with my range in which I would be willing to pay for the business. So that ranges from $50 billion up to $74 billion. And on a per share basis, that's $110 to $170 per share. Now, the current price for the stock for COSTCO is $412 per share with a market cap of $182 billion. The models above use a required rate of return of 9.5% instead of 22%. So for those who are new here or maybe don't understand what I'm doing here, I'll try and explain it a little bit. So when I'm figuring out what price to pay, I put 22% into the required rate of return, and that tells me the buy price. But we can also work the other way. If we make the buy price in the models equal to the current stock price by changing the required rate of return, then we can figure out what is the expected return of the business. So in this case, if you use these models and you put 9.5% as the required rate of return, so that's our target return, you can see that under Model 3, the buy price is about the current stock price. So what that means is if we're targeting 9.5% per year, then we would be willing to buy the stock today. And in other words, that means that the expected return, what we should expect to make if Model 3 is accurate, is about 9.5% per year if we bought the stock today, which is, that's okay. I mean, comparatively to what we've looked at over the past, I don't even know now, 3-4 months, most stocks we've looked at have had an expected return of 6 to 8%. So having an almost 10% required rate of return for a business that is this good is quite impressive. So I think, they lean on the impressive side, but at the same time, they, it's not anywhere near the 22% that we're really looking for. So additionally, Model 5, which assumes COSTCO achieves similar market penetration in China as in the US, that has an expected return of 11.5%. So, if you think if that's going to happen, if they are going to reach full penetration into China, 15% of their population owning a membership, then you'll make about 11.5% per year. But there's no margin of safety for errors, right? If they underperform that, you won't make 11.5%. And we always need that margin of safety in case there are errors in our valuation. COSTCO is a great business. And if they continue to with their impressive expansion into new markets around the world, they will very likely deliver strong returns for shareholders. However, the stock is not currently offering any margin of safety for errors in our valuation, or in the event that COSTCO underperforms its huge expectations. It took a long time for COSTCO to reach, 15% of the population owning a COSTCO membership in the US. It could take, 20 years for them to do that in China. It may never happen in China. Maybe, there is some conflict between the US and China which prevents COSTCO from expanding there. There's a lot of possibilities of how things could play out for COSTCO over the next 10 years. That's why we need that margin of safety. And that's why we don't invest in businesses when the expected return is single digits. We want that expected return to be high teens at the minimum, but low 20s is really what we're looking for. So that when we invest in the company, we are so confident that even if the business misses the mark substantially or we're wrong in our valuation, that we're still going to make a 15% return or a mid to high teen per year percentage return. So with that said, I hope you guys got some value out of this presentation. And as always, if you have any follow-up questions, feel free to head over to the investor community and feel free to ask me in there. But with that said, I hope you guys have a great day and I'll see you in the next presentation.
All right, well, that brings us to the end of both parts of this little series where I was sharing my full stock analysis presentation on COSTCO. I hope you guys got a ton of value out of this, regardless of whether you're someone who will go on and sign up to Learn by Example and come join our community, our pretty small but tight-knit community. Regardless of whether that's you or not, I hope you got some value out of this video today and all of the other content that I post on YouTube for free. And I'd love to know your thoughts down in the comment section below on this video and your thoughts on COSTCO in general. And just one last final reminder, if you are interested in getting access to more stock analysis like this so that you can use them as examples in learning more about diving into the analysis process and completing analysis and essentially, ultimately, outperforming the market over the very long term, which is what we aim to do when investing in individual businesses, then consider joining our small community Learn by Example. You can get 30% off if you sign up using the code October during the month of October and before the 50 spots fill up. Whichever one of those two things happens first is when the promotional period will close off. And something I didn't mention in the previous video is you can actually schedule a call if you're really quick. You can schedule a call with me this week only, and we can have a 10-15 minute chat about your investing style and problems that you're facing, and I can help you make a decision as to whether or not Learn by Example would be something that is suitable for you. So that's available to you. I didn't mention it in the previous video, but you can also send me an email if you also have any other questions. But with all of that said, I hope you guys have a great week, and I'll see you guys in the next video.